The Canadian Securities Administrators recently published a notice clarifying that Canadian securities laws apply to cryptocurrencies. These securities laws are applicable to platforms that serve Canadian investors, regardless of their location. In addition, Canadian tax laws apply to cryptocurrencies and transactions involving them. The CSA has been aggressive in its pursuit of crypto platforms and has published names of firms on its investor warning lists. CSA issued the Staff Notice 21-327, which provides guidance on how securities legislation applies to cryptocurrencies. In particular, the Staff Notice discusses the circumstances where a cryptocurrency-related entity is subject to securities legislation, such as a platform or dealer. It warns that platforms may be liable under securities legislation if they provide users with a contractual right to a cryptocurrency asset. CSA notes that an ICO, or initial coin offering, closely resembles an initial public offering, IPO. In considering whether securities laws apply to an ICO, the CSA emphasized that it would look at substance over form in determining whether an ICO complied with securities law. For example, ICOs may be securities only if they are sold with a prospectus exemption or upon receipt from a regulatory authority. Canada has also recently released a staff notice on cryptocurrencies. This notice outlines the requirements of Canadian securities laws for cryptocurrency trading platforms and provides recommendations for modifications that are appropriate for the particular business models of these platforms. However, investors should consult with a professional before investing in any cryptocurrency-related product or service. In Canada, the BCSA and OSA have provisions for cryptocurrencies, and some provinces have issued administrative positions on narrow issues. The CRA does not levy a separate estate tax on cryptocurrency. However, the deceased person is considered to have sold their property at fair market value on the date of their death, and estates will likely be liable for capital gains tax on the value of the assets. The regulation of cryptocurrencies in Japan is a relatively recent development. The country has a relatively friendly regulatory environment for crypto assets, but growing AML concerns are prompting it to consider further regulation. It announced in December that it would introduce legislation in 2022 to regulate stablecoin issuers, which will largely focus on customer protection and limiting the opportunities for cryptocurrencies to be used for money laundering. These measures will likely include new security protocols and new obligations on crypto service providers to report suspicious activity. The proposed rule would bring crypto exchanges under Japanese bank laws. It would also prevent sanctioned countries from using the digital assets. The Japanese government is working with Western allies to implement the changes. The proposal would also affect foreign exchange companies. Cryptocurrencies have been widely used in Japan, but the country's regulations are not always clear. A working group report recommended that cryptocurrency exchanges are registered, and that transactions related to the digital currency are subject to money laundering regulations. Moreover, the working group recommended that cryptocurrency exchanges are subject to a system for protecting users. This way, customers can feel secure. In the meantime, Japan's regulations are likely to be one step closer to ensuring the success of the industry. Financial Services Ability warned JFSA in December, stating that the organization's management process was unclear and did not follow a transparent thought process. However, it did amend its digital assets listing criteria, and assess tokens that local exchanges want to list. However, the screening process took nearly 6 months. UK regulators have imposed new regulations on cryptocurrency exchanges. The new rules require crypto exchanges to report suspected sanctions breaches to the UK authorities. The new rules are a response to concerns that Bitcoin could be used to evade sanctions. They also explicitly include cryptoassets, notionally valuable digital assets like Bitcoin. In addition to the new regulations, the Financial Conduct Authority, FCA, has consulted on regulating the cryptocurrency industry. The regulator's guidance refers to certain types of cryptocurrencies as specified investments under the Financial Services and Markets Act 2000. In addition to this, regulated cryptocurrency exchanges must be registered as money service businesses with the Financial Conduct Authority. The EU is also working to develop new rules to govern the industry. The EU's GDPR and 6AMLD are two leading initiatives. The UK's Financial Conduct Authority even coined the term RegTech in reference to the crypto industry. Regardless of which regulatory approach the UK takes, the crypto industry is growing quickly, and the UK should take steps to protect its reputation as a decentralised finance hub. UK regulators also need to regulate cryptocurrency exchanges. These exchanges must register with the FCA and comply with AML/CFT reporting obligations. Unlike many other countries, UK exchanges are required to be registered with the FCA, making them subject to the FCA's AML/CFT regulations. The FCA's latest guidelines also include new AML/CFT reporting requirements. As of January 2020, UK cryptocurrency exchanges are subject to the same standards as traditional banks. Regulation of cryptocurrency exchanges in the UK aims to protect consumers. While there are several aspects of the industry that need to be addressed, some of them are overlapped with existing regulations. For example, the UK financial regulatory framework already applies to transferable securities, such as bonds, shares, and depository receipts. Regulation of cryptocurrency mining in France is set to become more strict following recent comments by the Finance Ministry. The main reason behind these proposals is to prevent terrorism financing through cryptocurrencies. However, this measure could also be implemented to crypto exchanges that are operating in France. A detailed report is expected later this year. Regulation of cryptocurrency mining in France is not new. It has been permitted in the country for some time, but there are still some challenges. For one thing, there are no existing regulatory frameworks in France that regulate the activity. This makes it difficult for foreign investors to set up a business in France. France has welcomed a controversial cryptocurrency exchange called Binance. However, the European Commission has also proposed a framework for regulating crypto firms, which could make Europe the global center of gravity for the industry. The regulators' proposals also highlight the importance of educating the public about the dangers of digital assets. Cryptocurrency mining is taxed differently depending on whether the cryptocurrency is acquired as a profit or an investment. A business owner who buys cryptocurrency and pays with another cryptocurrency will pay 30% capital gain tax, but if they sell it for €305 or less, they won't have to pay capital gains tax. In addition, there are different tax rules for commercial cryptocurrency mining. In France, if the mining business is non-commercial, it will not be subject to tax. However, if the mining business is not for profit, the company will face a 45% tax rate. France's new crypto regulations come into effect in June 2021, and they will affect French companies and international crypto firms that wish to operate in France. They represent one of the most drastic changes in the sector since the beginning of 2019. Businesses will be subject to mandatory registration and stricter KYC requirements. Luxembourg has always been a hub for financial services, and its pragmatic approach to its laws is reflected in the regulation of cryptocurrency exchanges. The financial sector regulator recently recognized the potential of public electronic registration mechanisms such as blockchain to offer greater transparency and certainty in financial markets. This new law is a step towards making Luxembourg's financial system one of the safest in the EU. Cryptocurrency exchanges operating in Luxembourg should meet a number of criteria. First, they must not offer financial services or products to non-professionals. A regulated fund cannot invest in a cryptocurrency exchange without a prior written authorization from the CSSF. Similarly, a pension fund cannot invest in a token that is not backed by physical assets. Crypto assets are volatile and unregulated in many European countries, including the UK. Investors must be cautious and exercise caution when investing in them, as their capital is at risk. Luxembourg is similar to Switzerland, which is an international financial center, and is known for its respect for privacy. The country also offers favorable tax implications for businesses. These benefits and its regulatory approach have made Luxembourg a hotbed for Bitcoin investors. Bitstamp is a Luxembourg-based cryptocurrency exchange that allows users to trade Bitcoin and other cryptocurrencies for fiat currencies. In addition to Bitcoin, the exchange also supports the following cryptocurrencies: Algo, XRP, Litecoin, and USD Coin. Bitstamp is one of the oldest crypto companies in Europe. The new regulation requires virtual currency service providers to identify their customers and their beneficial owners. It also requires them to screen for money laundering and terrorist financing risks and report suspicious activity. The legislation also requires exchanges to have a payment services license.